Hello, everyone. Thank you for joining us today, July 12th. Please keep in mind that anything discussed on the video is not financial, legal, nor tax advice. Please contact us individually to discuss specific situations. Julian, how did the market wrap up today?
Overall, the S&P 500 closed today at approximately 3,800 for a year-to-date drawdown of about 20%. As we come off a statistically more volatile first half of the year, our opportunity as investors has grown. Among the choppy stock prices, we see several positives in the market. For example, our large cap stock holdings continue to pay strong dividends. For the second quarter of 2022, that is April through June, the companies in the S&P 500 paid out a record $140.6 billion in dividends. For full year projections, estimates have dividends jumping 10% in 2022 from last year's record. That would be the first double-digit increase since 2014, showing strong profitability of companies thus far. Jackie, what's important to note as we continue quarter three?
Through the first half of 2022, the Federal Reserve has consistently raised rates to combat inflation, with the most recent hike at 0.75%. With that, the Fed expects to initiate another increase of the same percentage at the end of July, followed by additional smaller rate increases throughout the year. With that in mind, we look to our JP Morgan research guide to the markets to evaluate our opportunity ahead.
Here we can see the last 42 years of S&P 500 returns. Each gray bar represents a year, and each red dot represents the intra-year drawdown, the pullback within that given year. For example, on the far left in 1980, we can see the intra-year drawdown was 17%, with the end of year growth at a positive 26%. With this in front of us, it's clear that these intra-year drawdowns are very common, averaging drops of 14%. Even with these pullbacks, annual returns were positive in 32 out of 42 years. While past performance is not indicative of future results, it's clear that these repeated drawdowns can be viewed as opportunities to buy into the market for the future. Jackie, what moves have we been making to capitalize on the discounted stock prices?
There are several proactive adjustments we have been making and will continue to make to take advantage of today's market. The first, Roth conversions. We continue to review each account to evaluate the merit of converting a portion of pre-tax retirement funds into post-tax retirement funds. This enables the funds to grow tax-free into the future. The second, tax loss harvesting, a strategy we employ to maximize your after-tax return within each taxable investment account. And the third, should the pullback continue in the short term, we will increase our stock holdings to increase our level of participation as the market recovers. On top of that, our team continues to proactively rebalance, taking advantage of these lower valuations. Should you have additional cash beyond that earmarked for an emergency fund or cash buffer, it presents a good opportunity to put those funds to work in a diversified portfolio for the long term.
We understand these healthy corrections can be uncomfortable, but we have planned ahead for each and every client so that we can capitalize on volatility during times like these. Please don't hesitate to reach out if you have any questions for us. Thank you everyone for joining us today. And as always, we appreciate the trust and confidence you have placed in our team. Have a great week.